Hello everyone and welcome to Financial Accounting. In this video we're going to go over Chapter 10, which is about liabilities, and we're going to focus on current liabilities, installment notes, and contingencies. So the first part, which is the current liabilities, I think it's easy because we all can relate to after going over the first few chapters where we have seen accounts payable, notes payable. So we'll see the different forms of liabilities that has to be satisfied or have to be satisfied within a short period of time, which is typically less than 1 year. Once we're done with that, we're going to get exposed to something called installment notes and contingent liabilities, or simply contingencies. So when a company or bank extends credit or give credit, it's making a loan. The company or bank is called the creditor, or what we normally call it the lender. But in accounting terms, we like to call it the creditor. The individuals or companies receiving the loan are called debtors, or simply the borrowers. So long-term liabilities are debt due beyond 1 year, and remember that. So long-term, or the cutoff period, is 1 year. If it's more than 1 year, it's considered to be long-term liabilities. If it's less than 1 year, we call it current liabilities. So current liabilities are debts that will be paid out of using current assets and are due within 1 year. So the most common example that we've seen for current liabilities is accounts payable. And something related to that is just general accruals. But accounts payable is very easy to relate to. So whenever I buy something from a supplier or vendor and I promise to pay them within, let's say, 30 days, I'm going to record an accounts payable on my side or on my records. So accounts payable transactions involve a variety of purchases on account, including the purchase of merchandise and supplies. Accrued liabilities reflect an obligation to pay current assets in the future. Accrued liabilities are normally recorded at the end of an accounting period as part of the adjustment process. And again, we've seen that in Chapter 3 where we were doing our adjusting entries. And one of the very typical accrued liabilities is wages payable, for example. So let's start with the short-term notes payable. That's another example for current liabilities. So notes may be issued to purchase merchandise or other assets. Notes may also be issued to creditors to satisfy an accounts payable created earlier. So the strong thing about notes payable is that it's a written document. So whenever I'm writing or signing a note to my vendor or supplier, I think this is a stronger document. And usually notes payable would involve interest. So that's another thing that would make the supplier or vendor more comfortable. At least they're getting some interest within the period that I'm going to pay them back their money. So let's see an example. Assume that Nature's Sunshine Company issued a 90-day 12% note for $1,000, which was dated August 1st to a company or supplier called Moray Company. For a $1,000 overdue account. So in other words, this was an accounts payable that we are going to replace with a notes payable. So we didn't pay the accounts payable on time, so we're going to provide Moray with a notes payable. So the journal entry to record this transaction or event is very simple. We're going to debit accounts payable, and when we debit the liability, remember, liabilities, they have a credit nature, so they prefer the credit side. So they increase on the credit side, they decrease on the debit side. So when I'm debiting accounts payable here on August 1st, in this case I am reducing the accounts payable and I'm replacing it with a note. So we have notes payable, which is also for Moray Company for the $1,000. So in other words, the notes payable are increasing or going up and the accounts payable are going down. So when the note matures, the entry to record the payment of the $1,000 plus the $30 interest, which is calculated as the $1,000 of the value of the note multiplied by 12%. And remember, the 12% is always an annual rate, even if the note is written for 90 days, as this case here, or 3 months. It's still, the interest rate still applies to the entire year. So we have to divide the interest rate by 360 and multiply by 90 days. And again, we use 360 for simplicity. In real life, they usually try to be very precise. They go calculate the interest day by day. So on October 30th here, we're going to debit the notes payable. And when we debit the notes payable for the $1,000, we're canceling it. Remember, in the previous journal entry, when we issued the note, we credited. Now we are paying it off, so it has to be debited. And then we're going to credit the cash, which is the amount of the note that we have to satisfy. Now we paid the interest on top of the value of the note, so it's $1,030. And remember, interest is interest expense, and expenses are typically on the debit side. So interest expense is going to be also debited. So this journal entry here is going to include 3 accounts. 2 of them are just the regular payment of a note, where we debit note and we credit cash. But since we are paying also on top of the note the value of the interest for the 90 days, in this case we have to calculate also, or we have to record the interest expense. So the journal entry would be debiting notes payable for the $1,000, recording the interest expense for $30, and crediting cash for $1,030 for the total value of the note and its interest. So each note transaction affects a debtor, which is the borrower, and a creditor. So let's see how this would look from both sides. And I think it's easy. We're in this chapter here, we're focusing mainly on the borrower, because they are the ones who are recording the liability, or in other words, the debtor. But we also want to see how it would look from the other side, which is the creditor or the lender. So let's see here a few examples. On May 1st, Bowden Company purchased merchandise on account from Cooker Company, $10,000 and 30, which is net 30. It has to be paid within 30 days. The merchandise cost Cooker Company $7,500. So this is our main focus here, which is Bowden Company, the borrower. And by the way, they use Bowden and Coker just to remind you, like, this is borrower and C for creditor. So for Bowden, they're going to debit inventory and credit accounts payable. Okay, $10,000, $10,000. Inventory is an asset purchased. Accounts payable is a liability that's increasing for $10,000. From the creditor side, remember, they are making sales, so they have to record 2 journal entries since they are using the perpetual system. We're going to debit accounts receivable and credit sales for the selling price, and then we're going to record the related journal entry for the cost of goods sold based on the cost of the merchandise sold, which is only $7,500. So they debit cost of goods sold, which is an expense account, and we credit inventory for $7,500. At the end of the month, Bowden Company issued a 60-day 12% note for $10,000 to Coker Company on account. So they didn't satisfy the accounts payable. Instead, they're going to issue a notes payable. So we are going to cancel the accounts payable. So we are going to debit it by $10,000. And this should be on the credit side. I think it's a typo here. This should be on the credit side, notes payable, $10,000 on the credit. We never see anything where debit and debit are on the same side. So this should be on the credit side. And then for Coker, which is the creditor, they're going to replace the accounts receivable with a notes receivable. Remember, receivables are an asset, so we're going to debit the notes receivable, where we increase the notes receivable, and we credit the accounts receivable for the same value, the $10,000. The $7,500 now is irrelevant because we already recorded the cost of goods sold, and the inventory has been reduced by the same value, so we don't need to worry about that. We're only replacing the accounts receivable with the notes receivable. So July 30th, which is after 60 days, Bowden Company paid Coker the amount due on the note of the May 31st. So we have to calculate the interest, which is not too complicated. We take the $10,000, multiply by 12%, which is the annual rate, the yearly rate, and we multiply it by 60 divided by 360. Because remember, it's between May 31st and end of July, it's about 2 months. So for Bowden Company, we're going to get rid of the note payable, $10,000, as we've done before. We're going to debit interest expense, which is about, based on our calculation here, which turned out to be $200. And then cash should be $10,200 on the credit side. And again, this is, I think the table is a little bit messed up here, so please forgive me for that. It should be on the right hand side, or like, I mean in this spot here, $10,200. For the creditor, it's just the image of that. So they receive the cash. They are not the ones paying the cash. So they receive the cash, the 10,000 and the interest. So it's 10,200. And then they have interest revenue of $200 based on the same calculation. And then notes receivable is reduced on the credit side for $10,000. So that's how simple it is and how you can see it from both sides. So a company may also borrow from a bank by issuing a note. Sometimes instead of you're issuing a note to the supplier or to the creditor, you're here, the creditor is a bank, and I'm just borrowing cash. It's not I'm buying inventory or anything like that. So assume that on September 19th, Iceberg Company borrowed cash from First National Bank by issuing a $4,000 90-day 8% note to the bank. Remember, the 8% is an annual rate. We have to adjust it by taking the 90 days divided by 360. But we're going to worry about that once we're calculating the interest. When we're issuing the note, we don't need to worry about the interest at that point. So the entry to record the issuance of the note and the cash proceed would be very simple. We're going to debit cash because we're receiving $4,000 from the bank, so cash is increasing. And also we're increasing our liability, so we're issuing notes payable for $4,000. On the due date of the note, which turned out to be December 18th, Iceberg Company owes First National Bank $4,000 plus interest of $80. How did we get the interest? Again, it's the principal, which is the value of the note, $4,000, multiplied by 8%, multiplied by 90, divided by 360. So that would give us $80. So we are going to cancel the note, so we debit the note for the $4,000. We're going to record the interest expense. Remember, interest expense, it's an expense. Expenses are always debit. Interest revenue, if I'm the creditor, I record it on the credit side. Revenues are credit. And then we credit cash for $4,080, which is the total of the note and the interest, which is the amount of cash we pay the bank after 90 days. So sometimes the agreement is a little bit different. We don't have an explicit kind of interest to be added to the note. Sometimes we use something called a discounted note. So in some cases, a discounted note may be issued rather than an interest-bearing note. Sometimes they refer to it as a non-interest-bearing note, which is a discounted note. So it's a note that promised to pay the creditor, let's say $1,000, but today I'm going to borrow a little bit lower amount. So let's say $950 or $920. So I'm borrowing $920, but I'm paying $1,000. So that we call it a discounted note. It's the same concept, but instead of just mentioning interest, we mention a discount rate. So a discount note has the following characteristic. The interest rate on the note is called a discount rate, so remember that. And the amount of interest on the note, called the discount, is computed by multiplying the discount rate times the face amount of the note, which is how much we're going to pay the creditor or the lender at the maturity date of the note. The borrower or the debtor received the face amount of the note less the discount. And this amount, which is the face amount minus the discount, is called the proceeds. So let's say the face amount of the note is $1,000 and the amount of discount is $50. The proceeds is $950, which is how much I'm receiving today. The debtor must repay the face amount of the note on the due date. So let's see how this works. Assume that on August 10th, Carey Company issues a $20,000 90-day discounted note to Western National Bank. The discount rate is 9% and the amount of the discount is $450. So how did we get the $450? We just took the $20,000, which is the face value of the note. 9% is the discount rate. 90 divided by 360, and that turns out to be $450. And it's just make sure that whenever you're using your calculator, take your time, make sure that you plug in the numbers correctly, because you don't want to mess up the numbers by just entering or doing wrong calculations. 9% is the same on your calculator as 0.09, or just 9 divided by 100, or if you have a percentage sign on your calculator, just make sure that you know how to use it. So therefore, the proceeds received by Carey are $19,550, which is the $20,000 minus the discount amount, or the discount amount, which is the 450. So the entry by carrier would be as follows. The amount of cash we're going to receive on August 10th is only $19,550. Remember, we're issuing a note for $20,000, so we're going to credit notes payable for $20,000. And the difference, $450, at the date of issuance is going to be recorded as interest expense. And again, we have different options, but since this is short term, we can record interest in the same period right away. So interest expense is $450. Again, according to generally accepted accounting principles, it's not correct to recognize the expense before it happens. But again, since this is only happening within the year, it doesn't make a big difference. We're going to record the interest expense. If we record the discount now and then amortize it later on in November, it's going to lead to the same thing. But don't worry too much about it. I'm just trying to be politically correct when I'm saying interest expense recorded at the time we're issuing the note. But that's how the journal entry would look like. We debit cash for $19,550 and we credit notes payable for $20,000, and the $450 is going to be debited for interest expense, which is the amount of the discount. So what's going to happen at maturity? The entry when Carrie pays the discounted note on November 8th, which is the maturity date, we're going to debit notes payable, and when we debit notes payable, that means that we're canceling it for the full value, $20,000, and we're paying cash of $20,000. So we actually borrowed $19,550 and we paid back $20,000. So if you think about the interest rate, it's actually $450 for the $19,550 that we borrowed, and that's the actual interest rate that we've used. Something called the current portion of long-term debt, that's another example for short-term liability. So the current portion of long-term debt, such as the current portion of installment notes, are reported on the balance sheet as current liability. An installment note is a debt that requires the borrower to make equal periodic payments to the lender for the term of the note. Installment notes are often used to purchase property, plant, and equipment. So let's say I'm buying a building. I have long-term debt for 15 years, but it has installments that we pay on a monthly basis. All payments that I need to make within the current year is considered to be a current portion of long-term debt and would be classified under current liabilities. But anything that's beyond the year would be long-term debt. So let me stop here. In the next video, we're going to talk about payroll liabilities, which is also a very interesting part related to